Now that we've covered escrow instructions and how amendments are handled, it's time to focus on the final and most anticipated step of every Arizona transaction, the closing process. This is where everything, the title report, loan, escrow instructions, and documentation, comes together in one carefully orchestrated moment known as the close of escrow, COE. At this stage, escrow officers prepare the settlement statement, verify the final details, and complete all legal steps necessary to record the deed and distribute funds. Understanding the settlement statement. The settlement statement, also known as the ALTA closing disclosure or closing statement, is the financial blueprint of the entire transaction. It shows every debit and credit for the buyer and seller, including purchase price, loan amounts, prorations, recording fees, commissions, title insurance premiums, and other closing costs. Escrow companies in Arizona use the Standardized American Land Title Association, ALTA, format, ensuring transparency and compliance with state and federal laws such as RESPA, Real Estate Settlement Procedures Act, and ARS, paragraph 6-834. The statement must balance to the penny. Escrow officers double-check every figure before closing, since even minor errors can delay recording or create post-closing disputes. Example: in a Tempe home sale, the escrow officer noticed that HOA transfer fees were mistakenly charged to the buyer instead of the seller, contrary to the contract. The agent caught the error during the final review, and escrow corrected it before closing. This attention to detail saved both parties from confusion and prevented a possible violation of R4 282-1101E, which requires accurate disclosure of material information. Prorations, dividing costs fairly. One of the most important functions of the settlement statement is the proration of recurring expenses like property taxes, HOA dues, and sometimes rents or utilities. Prorations ensure that buyers and sellers each pay their fair share based on the close of escrow date. In Arizona, property taxes are paid in arrears, meaning the taxes due in October and March cover the previous 6-month periods. Under ARS paragraph 42-17-153, property taxes are a lien against the property as of January 1st each year, even though they aren't payable until later. Example: if a property closes on July 1st, the seller owes taxes from January 1st through June 30th. Escrow prorates that amount as a debit to the seller and a credit to the buyer, ensuring the buyer doesn't pay for time they didn't own the home. This calculation is automatically handled by escrow software, but agents should still be able to explain how it works when clients review their statements. Disbursement of funds. Once all amounts are verified and approved, escrow prepares to disburse funds. According to IRS paragraph 6-834, no money may be released until all written instructions have been satisfied and the deed has been recorded under IRS paragraph 33-4111. Funds are distributed as follows. The seller receives sale proceeds via check or wire transfer. The listing and buyer's brokers receive commissions per contract. Title insurance and recording fees are paid. The buyer's lender wires loan funds to escrow. Any outstanding liens or payoffs, such as the seller's mortgage, are cleared. Example: in a Chandler sale, escrow received loan funds from the lender at 11 a.m. The officer confirmed recording of the deed at 2:30 p.m. and released all funds immediately after. By ensuring recording occurred before disbursement, escrow complied with ARS paragraph 6-834 and prevented potential double liability. The close of escrow, COE. As noted earlier, close of escrow occurs when the deed is recorded and funds are disbursed, not when the parties sign paperwork. This distinction is critical. Arizona agents must always use the term COE correctly when negotiating contract timelines or possession dates. Possession typically transfers to the buyer upon COE, unless otherwise agreed in writing. Delivering possession before COE without written authorization can violate R4 28-1101J, which prohibits agents from permitting occupancy prior to closing. Example: a Phoenix buyer moved into the home 2 days early with the seller's verbal permission. The deal fell through due to financing, and the seller had to pursue eviction. The agent was cited under R4 to 28-1101J for allowing early occupancy without broker and seller approval. This case highlights how critical it is for agents to protect their clients by strictly following ADRI's rules. Final review and compliance. Before declaring the transaction closed, escrow officers confirm that all title requirements from Schedule BI are satisfied. The deed has been recorded with the county recorder. Funds have been disbursed according to the written instructions. Final copies of the settlement statement are delivered to all parties and their brokers. Brokers are required under ARS paragraph 32-2151.01 to maintain copies of all closing documents, including the settlement statement, escrow instructions, and contracts, for at least 5 years. Agents should also retain digital or printed copies for their personal records in case questions or audits arise later. Arizona example. A Scottsdale agent discovered after closing that the lender's credit for appraisal fees had not been applied. Because the agent kept a copy of the final settlement statement and immediately contacted escrow, the issue was corrected within hours. This proactive follow-up not only protected the client's funds, but demonstrated compliance with R4 28-1101A, acting in the client's best interest. Key takeaways. The settlement statement is the final financial summary of the transaction, showing all costs, credits, and prorations. Escrow cannot release funds until recording has occurred, and agents must understand how taxes, fees, and commissions are calculated. Possession transfers only after COE, unless otherwise agreed in writing. Agents and brokers must ensure all closing documents are reviewed, accurate, and retained per ARS, paragraph 32-151.101.